Something has been quietly developing over the last several hours, and it is receiving a fraction of the attention it actually warrants. Saudi Arabia, the UAE, Kuwait, and Qatar, four of Washington's most strategically vital Gulf partners, are now actively weighing the termination of existing contracts with the United States and the cancellation of forward investment pledges made to America. Sit with that for a moment, because the full weight of it demands processing. This is not Tehran. This is not Moscow. This is not Beijing. These are the countries that have sheltered American military installations on their soil for generations. These are the countries whose leaders sat across from Trump in Riyadh in 2025, announced hundreds of billions of dollars in investment commitments, and signed off on the deal. And now they are reportedly considering the withdrawal of that capital. What we are watching unfold is not a minor diplomatic friction between partners with slightly misaligned preferences. It is a structural renegotiation conducted not through embassy letters or formal summits, but through the implicit threat of capital withdrawal on a scale Washington has genuinely never had to confront from this side of the relationship before. Today, we are going to work through every layer of this properly. The numbers, the mechanisms, the consequences across economic, geopolitical, and strategic dimensions, because buried inside this story is something that goes far beyond any single policy decision. Before you can understand why this threat carries the weight it does, you need to understand what these four countries actually represent inside the American economic system, because most coverage dramatically underestimates the scale. In 2025, the 7 primary sovereign wealth funds operating out of the Gulf region collectively accounted for 43% of all capital deployed globally by state-backed investors. The combined outflow from those funds in a single year reached $126 billion. 1 year, $126 billion. And that figure was recorded before any of the current situation began, before a single piece of infrastructure had been struck, before a single energy facility had been knocked offline, before a single data center had been damaged. Saudi Arabia, the UAE, Kuwait, and Qatar are not merely defense partners in a transactional security arrangement. Their sovereign capital is structurally woven through American commercial real estate, technology companies, private equity funds, infrastructure financing, and financial markets from coast to coast. The Qatar Investment Authority placed capital into prominent American investment vehicles. The Abu Dhabi Investment Authority holds positions across American financial markets so vast they would require years to fully exit in any orderly manner. These are the nations whose capital exposure was apparently not factored in as a strategic variable when the decisions that triggered this situation were made. That gap, if that is indeed what it represents, may prove to be one of the more consequential strategic oversights in recent memory. To understand why these governments are moving in this direction, you need to look at what they have been forced to absorb in concrete, measurable terms, because we are not talking about symbolic inconvenience or political awkwardness. We are talking about quantifiable material damage inflicted on nations that did not initiate this conflict, did not formally participate in the actions that triggered the response, and were not brought into the planning process before things began. Since late February, these four countries have been converted into active target zones for Iranian counter-operations, not because any of them formally joined the campaign. None did, at least on the public record. But because they host American military infrastructure, their territory entered into the operational logic of the retaliation regardless. The intercept figures alone are remarkable. The UAE has been forced to engage 165 ballistic missiles, 2 cruise missiles, and 541 drone systems. Kuwait intercepted 97 ballistic missiles and 283 drones. Qatar neutralized 10 missile and drone systems. Bahrain engaged additional projectiles in its own airspace. And those are only the confirmed intercepts, the systems that were stopped before reaching their intended targets. 35 drones successfully penetrated UAE air defenses and caused physical damage the Emirati Defense Ministry was compelled to acknowledge publicly. Fires in Dubai, structural impact near prominent landmarks, explosions in Abu Dhabi. And then the detail that drew global attention when it was first reported. A fire broke out inside an Amazon Web Services data center in Dubai. That may represent the first confirmed instance in the modern era of a major cloud infrastructure facility sustaining damage within an active conflict zone. The implications for data reliability, for regional technology investment confidence, and for the entire digital infrastructure thesis of the Gulf are still being assessed. In Saudi Arabia, the Ras Tanura refinery was struck and removed from service. This is not a peripheral installation. Ras Tanura is one of the largest petroleum processing complexes on Earth, a cornerstone asset inside Saudi Aramco's production architecture and a key pressure point in global energy supply chains. Even a temporary shutdown sends price signals through every commodity market connected to oil importing nations anywhere in the world. In Qatar, the consequences were immediate and felt globally. Qatar Energy was forced to fully suspend liquefied natural gas production following infrastructure strikes. Qatar holds the position of the world's single largest LNG exporter. After Russian pipeline gas was cut off from European supply, Qatar became the primary energy lifeline keeping European industry and households running. When its output halted, gas markets responded in real time. European natural gas prices surged 66% within a single week. Not 6, not 16, 66%. For governments and industries across Europe still managing the financial damage of the previous energy disruption, that is not a data point. It is an economic emergency arriving on top of an existing wound. The aviation picture tells a parallel story with its own weight. In the days following the initial response operations, more than 70% of all scheduled flights into the UAE, Qatar, and Bahrain remained grounded. Dubai International, the world's busiest international airport by passenger volume, processing roughly 95 million travelers annually across approximately 8,500 weekly flights, was effectively shut down for an extended period. Financial markets in Saudi Arabia and Qatar declined sharply in the immediate aftermath. Exchanges in the UAE and Kuwait suspended trading sessions entirely, choosing to halt price discovery rather than allow uncontrolled selling under conditions of acute uncertainty. That is the economic invoice from the first week alone, a situation these governments did not choose, did not request, and were not warned about in advance, and the bill has been growing larger with each passing day since. Now we arrive at the central question this situation demands. Why are these governments actually considering pulling their investments? What is the reasoning that takes a country from intercepting ballistic missiles on one day to threatening American capital withdrawal within the same week? For these Gulf states, this situation is attacking their economic model along three separate and compounding fault lines simultaneously. Understanding all three is essential to understanding why this threat carries genuine weight rather than functioning as a symbolic gesture. The first fault line, direct revenue destruction. Dubai, Abu Dhabi, and Doha have not spent 2 decades building global reputations by accident. These are not economies simply hedging oil revenues behind sovereign wealth buffers. These are sophisticated, diversified economies that attracted international capital, global corporations, high-skilled talent, and international tourism by offering something very specific, a stable, reliable, and predictable operating environment positioned at the intersection of global trade flows between Europe, Asia, and Africa. When Dubai International shuts down, the damage extends far beyond canceled flights. The entire economic model of the UAE is built on the premise of being the world's most reliably connected hub. Every week of shutdown erodes the foundation of that reputation in ways that take years to rebuild and cannot be reversed by any official statement. The data center fire compounds this significantly. The technology investment thesis for the Gulf was constructed on the argument that sovereign digital infrastructure in a stable, well-governed zone between European and Asian time zones offered a superior value proposition to global technology firms.
A cloud facility sustaining damage during active hostilities is direct, observable evidence against that thesis. Every technology company with regional exposure will be reassessing its infrastructure strategy in ways that affect long-term investment commitments. The second fault line, energy revenue disruption. For Saudi Arabia and Qatar in particular, energy revenue is not a secondary income stream. It is the foundational economic resource that funds government operations, social programs, sovereign wealth accumulation, and long-term diversification strategies. When Ras Tanura goes offline, the financial impact is direct and immediate. When Qatar Energy suspends liquefied natural gas production, the revenue interruption is quantifiable by the hour. These are not abstract balance sheet concerns. They are operational realities affecting the fiscal position of governments that are simultaneously being asked to absorb the security costs of intercepting hundreds of missiles and drones on behalf of an alliance whose decisions they were not consulted about. The math of that arrangement is straightforward. Revenue down, defense costs up, and no seat at the table when the decisions driving both outcomes were made.
The third fault line, long-term investment confidence. Perhaps the most strategically significant dimension is the least immediately visible. The entire economic transformation strategy of the Gulf, the multi-decade effort to attract global capital, diversify away from hydrocarbon dependence, build technology sectors, develop tourism, and position these cities as global financial centers, depends on a single foundational premise: that the Gulf is a stable and secure destination for long-term capital. A conflict that places ballistic missiles over Dubai, fires cloud infrastructure in Abu Dhabi, and halts LNG exports from Qatar directly undermines that premise in the eyes of every international investor, every multinational corporation, and every global talent pool these economies are competing for. The damage is not just what happened this week. It is the signal this week sends about what could happen next year and the year after. When you combine all three fault lines, direct revenue destruction, energy income disruption, and long-term investment confidence erosion, you begin to understand why the leadership of these countries is not primarily reacting emotionally. They are responding to a structural economic threat to the foundations of their national development models. And they have identified a lever, capital withdrawal, that is proportionate to the scale of the damage they are absorbing. Let us be specific about what this withdrawal threat actually looks like in practice, because it is not a single binary outcome. It operates along a spectrum, and understanding each level clarifies the actual choices Washington now faces. Scenario 1. Symbolic suspension of forward commitments. In this scenario, Gulf governments pause certain upcoming investment signatures, redirect some sovereign fund flows toward non-American destinations on a limited basis, and communicate clearly, but through private diplomatic channels rather than public announcements, that the full economic relationship is now explicitly conditional on demonstrated movement toward de-escalation. The immediate financial impact of this scenario is more symbolic than structurally damaging, but the political message it delivers is precise and unambiguous. It represents a formal notification from Washington's most financially significant regional partners that the alliance has entered conditional territory. For an administration closely focused on economic performance signals, that notification carries political weight that is difficult to ignore regardless of the direct financial magnitude. Scenario 2. Sustained reallocation of sovereign fund capital. This is where the consequences become measurable in ways that reach ordinary American households and businesses rather than remaining confined to diplomatic relationships. Gulf sovereign funds deployed approximately $126 billion globally in 2025. If even 20 to 30% of those flows are systematically redirected away from American Treasury bonds, American real estate, and American equity markets toward European, Asian, or emerging market destinations, the effects move through the American financial system in visible and consequential ways. Reduced demand for Treasury bonds pushes yields higher.
Higher yields increase the cost of servicing the American national debt at a moment when debt service is already consuming a historically large share of the federal budget. Higher borrowing costs then cascade into mortgage markets, corporate financing, and consumer credit. The damage accumulates gradually rather than arriving in a single shock, but it is real, it is sustained, and it is politically attributable in ways that matter for an administration navigating existing economic pressures. Scenario 3. Cancellation of defense procurement contracts. This is the least likely in the near term, but carries the most structurally significant implications if it were to materialize. Saudi Arabia and the UAE are among the largest purchasers of American defense equipment anywhere in the world. Major American defense contractors across aerospace, weapons systems, and technology hold active Gulf contracts worth tens of billions of dollars across multiple ongoing programs. A sudden, comprehensive cancellation of those contracts would represent a genuine industrial disruption. Immediate consequences would include job losses in American defense manufacturing, damage to the unit economics of production programs that depend on international orders to remain cost competitive, and a signal transmitted to every other American defense partner globally about the reliability of the alliance relationships that underpin those commercial arrangements. No Gulf government is likely to reach for this lever first, but the fact that it exists and that it is on the table alongside the others shapes the entire negotiating dynamic. Before drawing this together, there is one additional element that cannot be set aside and that Washington appears to have underweighted considerably in its pre-operational planning. China sources more than 38% of its seaborne crude oil imports from the Middle East. Beijing has a direct structural interest in regional stabilization. Prolonged instability drives up China's own energy costs and introduces supply chain vulnerabilities into its industrial planning. On that dimension, China and the United States share a common interest in a stable Gulf. But China simultaneously has a profound strategic interest in exploiting precisely this moment to deepen and formalize its economic relations with Gulf partners who are actively looking for alternatives to their current dependence on the American-centered financial and security architecture. If Gulf sovereign funds begin systematically redirecting capital flows away from American assets, Beijing is positioned to absorb a meaningful share of those redirected flows. That would deepen financial integration between China and the Gulf at exactly the moment when American influence in the region is under its most significant stress in years. The long-term consequence, a sustained shift in Gulf capital flows away from American markets and toward Chinese ones, is almost certainly not what Washington was calculating when it made the decision to move without consulting its regional partners. But it is now a live possibility that each day of unresolved tension makes more rather than less likely. What this situation reveals at its most fundamental level is a dynamic that students of international relations understand clearly, but that decision-makers in every era consistently underestimate at the moments it matters most. In the contemporary world, military power and economic power do not exist in separate compartments that can be managed independently of each other. You cannot conduct major military operations in a region as economically central as the Gulf without generating economic feedback loops that ultimately affect the political sustainability of the operation itself. You cannot ask allies to absorb the costs of a conflict they did not choose, without eventually forcing them to make a calculation they would strongly prefer not to have to make, whether continued alliance loyalty actually serves their national interest. The statement that Iranian retaliatory operations against Gulf territory represented a surprise is more revealing than it may have been intended to be. If the closest regional partners of the United States are absorbing economically significant damage, and Washington's characterization of that outcome is surprise, it means the economic feedback from Gulf vulnerability to American alliance costs was not adequately modeled before the decision to act was made. And when those feedback loops are not in the plan, the allies who end up paying the unplanned bill eventually stop waiting for acknowledgement and start taking unilateral action to protect their own interests. The Gulf investment withdrawal threat is exactly that kind of action. It is the response of partners who were excluded from the decision-making, who are experiencing consequences they did not select and cannot easily escape, and who have identified an economic instrument, capital, that is powerful enough to force the conversation that diplomatic channels have not yet produced. What is being negotiated right now is not a military outcome. It is the price that Washington's Gulf partners are willing to absorb for a situation they did not vote for. And that price is being revised upward with each day the current trajectory continues without a credible path toward de-escalation that protects their economic interests alongside broader strategic objectives. All figures cited in this video are sourced and verifiable. We encourage you to cross-reference every number independently.